So let's get into Bitcoin and also some of the macro pressures that may continue to really adjust the market. That's been the big question here in early January as we record this, is the response, because Bitcoin, of course, has had a nice run here in the short term. And I think a lot of analysts have started to look at some new data that may represent the market conditions in a little different way. So we thought we'd dive in a little deeper on this one with some additional market analysts out there. And it's going to be a good one for you guys. My name is Paul Barron. Welcome back into Tech Path. Joining me today, of course, is Lyn Alden. She's been on our show before. Great to have you back, Lyn. Thank you.
Thanks for having me back. Happy to be here.
Yeah. So, Lyn, let's get into a little bit about what's happening, obviously, with Bitcoin right now. I'm going to jump over to this first article here over on Cointelegraph. This is basically just talking about Bitcoin seeing its new 4-month high. But at the same time, we're getting some conflicting data. And we look at the jobs data that has also come in here recently. We are seeing continued slides in the CPI aspect of inflation. And then we're also seeing retail data, and now we're going to get a chance to see some Q4 numbers coming in from a lot of the traditional securities. When you look at the market as it is right now, and we'll stay with Bitcoin first, and then I want to kind of get into some of the traditional markets with you as well. What is it, do you feel, that are the contributing factors to what we're seeing right now in Bitcoin's price movement?
So Bitcoin is historically highly correlated with various liquidity indicators, right? So basically, how much capital is kind of available, liquid for investment. A lot of other investments, they trade off things like earnings, they trade off all sorts of other things, whereas Bitcoin is actually one of the purest liquidity correlations that are out there. And ever since autumn of last year, liquidity conditions have actually been, in many cases, moving up or sideways a little bit. Basically, they declined all throughout 2022. When we got to the end of the year, the dollar index came off of its highs. You started to get Chinese reopening. You started to get, the market pricing in slower forward Fed hiking. Inflation was off of its highs. You had a drawdown in the Treasury General account. It's kind of jargon for some, but basically, there's a bunch of things that improve liquidity. And I actually think that Bitcoin probably would have bounced in quarter 4 if not for the whole FTX implosion. Because you started to see a bounce in a number of risk assets. We saw good movements in precious metals, including ones like silver, that are historically more cyclical. And so I think that basically this is kind of a pent up move from those overall better liquidity conditions. I think the somewhat concerning thing is that you're also seeing a bounce in like meme stocks
Mhm.
and unprofitable stocks this year. And so, I wouldn't be surprised to see some of this be given back or some of this, consolidate for a period of time. But essentially, I think that, liquidity, at least locally, reached its worst point last year and at least is kind of a mild, improvement.
So when you say the dollar, I'm looking at the Dixie chart right here. And to your point, if you look back here in really around October, which is again getting into Q4, and then we started to see that fall off in the dollar. And of course, back to your point of liquidity starting to kind of correct a bit. When you look at the liquidity scenario starting to adjust, do you feel like this is a short-term position, or do you think this is something that we could look at being a long-term trend starting to develop?
So I think that's going to partially depend on how adamant the Fed is in trying to tighten in the face of decelerating data. I think in most market conditions, this would probably be like a top in the dollar, and we'd see more easing conditions from here. Like historically, for example, when you see the 2-year Treasury roll below the Fed funds rate, usually the Fed is done hiking. And so, in normal market environments, these would probably start to signal a top. Now, because inflation is still historically high, because Jerome Powell has tied his reputation to getting inflation back down,
Right.
they could be a little bit stickier than they have been in prior cycles. So it's possible that we'll retest this. It's possible that we'll experience more turbulence. But I think this is at least the beginning of a rotation in liquidity, even if it's maybe not the final move.
It's interesting with the Fed. Let's stay on that for a second here. Obviously, Jerome Powell will be doing his FOMC meeting here in early February. We'll get a chance to see what that adjustment might look like. Are you in the camp of a 25 basis points move? I think we're seeing so much in that. What's your anticipation?
I think with the data we have at hand now, that's most likely. We recently saw, for example, industrial production came out pretty weak. We saw retail sales come out pretty weak. There's kind of broad-based deceleration. The New York Fed recession model is flashing recession. And so I think 25 basis points is probably the most likely scenario. Data between now and then could tweak those odds somewhat. Essentially, what we're seeing is that even though they're intending to continue tightening, they're intending to hold their tightness for longer. We are clearly seeing a deceleration of expectations around how much they're going to tighten, in large part because we've seen a deceleration in inflation and a deceleration in economic activity. So I think 25 basis points is most likely.
Yeah. With that being the case, Chair Powell talks about this often, and that is, some of the data indicators that they're looking at, which in most cases are lagging data numbers coming to the Fed. With that being the case around jobs, I want to stay on that for a second. We saw our second print of what is, I guess, better than expected job numbers. The likelihood is we may see that again in the next couple of months. Do you feel like jobs are going to be a critical component for the Fed to stay on a track to decelerate in terms of just being able to slow the amount of increases in not only interest rate, but also maybe getting to a point where we may see a pause? Do you think jobs are going to be a critical component for their decision making?
I think around the margins, yes, because for example, if you look at the Fed's mandates, they're not mandated to maximize industrial production, but they are mandated to maximize long-term employment, right? And so they look at basically employment and inflation as their two primary things to optimize for. By extension, they also have to optimize for financial stability. So, for example, if the Treasury market goes illiquid, if the junk bond market, if that goes completely liquid and stops trading, they pretty much have to step in because that's going to start eventually cascading into failures of financial institutions and employment. But really, at the when it comes down to it, those two initial mandates are what they optimize for. And so the challenge is, of course, is that employment is a lagging indicator, right? So usually you don't get substantial increases in unemployment until you're already in a recession. It's basically coincident or lagging compared to other things. Now we can isolate certain aspects of employment that are a little bit more leading. So, for example, if you look at temporary help, um, if you imagine running a business and you're facing challenges, you're more likely to let go of temporary help services before you'd let go your permanent employees that have more experience at your company. And generally, so you see a lot more volatility and a lot of kind of a leading indicator from temporary help, both on the upside and the downside. And that's already negative year over year, the total
Right.
people that are officially employed in that type of work. And so even in the labor market, which is pretty strong, we still see early cracks. Same thing for overtime hours. That's like another leading indicator. It's looking pretty soft. But as long as they're looking at broad-based employment, I do think that they can use that to justify staying tight for a little bit longer than you otherwise would if you're looking at leading indicators.
Yeah, okay. So jobs, obviously, one of those big indicators that for 2023 in terms of how Powell will start to kind of navigate the summer months, and as we see maybe a potential, I won't say reversal, but at least a pause in terms of rate hikes. How long do you think a pause? And I know it's all speculatory, but the idea is based on macro environment as it is right now, the trends we're starting to see all the way from last quarter, jobs starting to paint in. Now, real estate will play into this. Obviously, getting into price stability is going to be a reality. Are you in line with some of the analysts that are pointing to maybe end of year to reaching a new 2.5, 2% inflation rate?
I think that's quite possible, but the thing is, I think where I would differ from consensus is that I doubt we're going to stay there. I would expect future waves of inflation this decade.
Mm.
If you look at past inflationary periods like the 1970s or the 1940s, they often came in waves, and that's because policymakers and central banks don't just sit there and let it happen. Central banks try to push back on it. They try to tighten conditions, or sometimes you have policymakers doing things like price and wage controls. That was a historical move that would happen. And so, between different types of levers that different types of policymakers can pull, they usually get a handle on inflation for brief periods of time before it runs away from them again. And so right now, as they try to curtail demand, as they, basically suppress marginal demand, that helps bring inflation down. We also don't see, I mean, money supply was growing very quickly in 2020 and 2021. Basically, it was the fastest pace of broad money supply growth since World War II. But over the past 12 months, you're flat to negative in terms of broad money supply.
Right.
And so I would expect to see continued disinflationary pressures until there's a policy shift, in response to recession, in response to economic softness. And then probably from there, we would have another wave of inflation because some of the underlying shortages in energy supply, for example, are unresolved, even though they can be temporarily suppressed.
Yeah. Looking at the global picture, because some of the narratives, when you looked at last year, Q3, Q4, I think a lot of people were still continuing to see so much pressure from the EU, the Bank of Japan, when you think of Asia, and some of the macro elements that are starting to develop in both of those sectors of the global economy. Is there any one area that you feel is a little bit more dangerous for what we might see here, at least in the US markets?
Well, so Europe, obviously, the big warning sign there is the energy shortages, right? That shows how problematic things can be if you don't have your energy managed properly.
Mhm.
And the challenge with natural gas is it's a far more local market than oil and coal and other types of commodities because it's very costly to transport relative to its value, right? You need very specialized equipment. There's only so much. There's finite capacity for shipping natural gas, and so they've run into the shortages. And I don't think, right now they're off those highs, but I think that until they actually have a more structural investment, those could be recurring issues that you see next winter and maybe the winter after that.
Yeah,
On Japan's side, it's a very different situation. Obviously, they have similar shortages, but not as extreme. And instead, they're more like they're the highest debt nation in the world, and
right.
so what they're doing is actually rippling out because, for example, Japan, even though they're very high debt, they're also positive net international investment position, which means that they own more foreign assets than foreigners own of Japanese assets. That's from decades of running positive current account surpluses, which they then reinvest in the rest of the world. And so one problem is that when they do start to tighten a little bit, like we saw with the recent move from 25 basis points to 50 basis points on their 10-year, some of that capital goes back to Japan. In addition, official policymakers can sell some of their official reserves, which they have well over $1 trillion worth,
Mhm.
to prop up their currency, even if they have an artificially low interest rate. And so that withdrawal of foreign capital back into Japan can ripple through, the world because they're the largest,
Yeah,
country by net international investment position. So I think both of those are both warning signs and instructive, and they also then have rippling effects throughout the rest of the world. I mean, Germany is a major manufacturer, Japan
right.
is a major financier, and these are all interconnected.
And I think when, for our audience out there that are listening in on this, one of the key constructs that you have to really remember when you're investing, whether it's in risk assets like, crypto, Bitcoin, et cetera, or you're going in traditional security markets, leverage and also liquidity. Those are two major components that have to be active in the market for it to really kind of perform in different areas, and whether it's in bull markets or bear markets. Lyn, I know you've been kind of talking a little bit about leverage in the market as it is right now. Do you feel like the leverage has started to come off the market? Because we haven't really repositioned back in, but at the same time, we're getting some liquidity, blue sky, it feels like. What's your kind of your analysis of that right now? Because it's kind of two different polar opposites of what's happening in the markets.
So in equity markets, a lot of the margin debt has been rolled over, right? So basically, there was, during the big spike into 2021, there's
Mhm.
quite a lot of margin debt. A lot of that has been reduced, and obviously, we've seen a lot of debt implosions throughout the whole crypto ecosystem. That was basically debt built on debt in this big intertwined connection. So I think that's actually pretty healthy. I think there's still some pockets of debt. Obviously, we have to see what's going to happen with digital currency group and that full situation there. So
Yeah,
it's not like debt has been totally wiped out, and it's never, in recessions, you don't wipe out all debt from any industry. You just kind of wipe
right.
out the excessive debt around the margins. And so I do think that it is a much better debt situation than it was before, at least in that market sense, right? So there's still tremendous amounts of debt, for example, sovereign debt, corporate debt, household debt. But in a market sense, basically debt tied to trading assets, that's been significantly reduced.
Right, right. Yeah, credit in general, when you look at retail credit, yes, definitely big moves there. But to your point, in terms of leverage, definitely a different, scenario playing out. We just showed a tweet there by Dylan Clare. He was talking about the issue of DCG suspending dividends. Again, this is just more distress, at Genesis in general. How big of an issue do you feel that this poses to not only Bitcoin, but in general risk assets of what's happening with DCG and Genesis right now?
I think the biggest way it affects Bitcoin is how it affects their Grayscale trust, right? If this allows for redemptions, if this allows for a changing of ownership, if this gets stuck in a bankruptcy court
Right.
for a period of time, I think that's the biggest impact there because GBT is an absolutely massive holder of Bitcoin. More broadly, basically, I mean, they own large amounts of venture positions throughout the crypto ecosystem. Obviously, they're a major trading desk. But I think it's healthy to go through these cycles and clear out all these malinvestments because if you just always go up, of course you're going to get more and more leverage piled up. If you saw an investment that only ever goes up, the rational thing to do would be to leverage, right? If you were sure that it
Mhm.
was only going to go up. And so the only way that something can go up structurally is that it has to clear out a lot of that debt every once in a while.
Right.
And so basically, I think we still have a process to go through. If you look at historical Bitcoin bottoms, they usually, other than the March 2020 event, usually you don't have these V bottoms. Usually you go down, you crash, you
Right
capitulate, you go
there.
sideways for a while, and you correct both in space and time, and you clear all that out for a while, and then you start to build, right? So I
Mhm.
do think that, even though we potentially have seen the lows, I still think there's time to go through before you'd see another just super strong kind of structural rally to new all-time highs.
Right. So this more of a bear market rally, kind of the situation that we're dealing with right now around Bitcoin. Some people looking at this is maybe early indicators of some movement in the space. Questions still loom as to whether or not we're going to see a full-fledged recession here in the United States. I was again another tweet by Dylan. He was hitting in on the point around what Dosha mentioned, which is if you look at the scenario of historical recessions, we necessarily have not necessarily met that, and we're right there at the top that it kind of indicates right there on the 2021. We haven't been able to sustain that out around the potential of what this might look like in the next 12 months, providing that we still potentially will see that recession hit. Do you feel like that is a mid-year event? And are you thinking more long, or do you feel like this is going to be more of one of those situations that is a softer, scenario in terms of recessions?
I'm looking at a lot as like the post-dot-com recession, right? That was one where it was a
Okay.
major impact for markets and a smaller impact for the economy. But obviously, it's going to depend on how policymakers handle that. One thing I think is that a lot of people they fight the last war, right? So they look back, for example, at the 2008 recession, and now they start to fear that every recession is going to be like one of those. One big difference that I point out about this setup compared to that setup is that going into 2008, banks were the weakest they've ever been in terms of they had the smallest allocation they ever had as a percentage of their assets to risk-free assets like treasuries or bank reserves, and they had maximum exposure to loans, to riskier securities, and they had very loose lending standards, which means a pretty small rate of default could render them insolvent. Whereas now, because they're much more highly allocated to those safer assets, it takes a bigger problem to cause them to be outright insolvent. And so,
Yeah.
although recessions will impact banks, basically, for example, you'll incur loan losses if you do have a recession. I don't think the problem is going to emanate from the banks, right? They're not the epicenter of the crisis in the way that
Mm,
they were in 2008. And instead, I
exactly.
think it kind of, yeah, and that's how you get that explosive type of thing. When you have the banking system implode, that's more explosive. Whereas when you have it occur at the periphery, right? So first it's housing, right? Because the
Mm,
interest rates moved, housing activity slowed down. Also, auto loans have slowed down. The tech field, right? You have all these high valuation equities when cost of capital is free. Now that there is a cost of capital, those equity valuations have come down, which forces them to be more profitable, which slows their growth, which means you lay people off because some of that was just malinvestment. It was basically unrealistic expectations. So that gets slowed down, and of course this keeps rippling through more and more and more sectors because of course those people that lost their tech jobs are going to now buy fewer other things. The people that are not building houses are going to buy fewer other things. And so this is like the type of recession I think emanates from the periphery and then moves in, rather than say the 2008 crisis that started from the center
Right.
and then exploded outward from there.
Yeah, different, definitely a different makeup, in terms of how this market is going to respond. Back to your point of whether it's markets and or the general economy, really kind of attaching to what the next recession might play into. This may be a good thing for Bitcoin, and maybe a good thing for risk assets in general of how to play into this, because in many cases people will use that as a hedge in lieu of what we might see in the securities market. I'm going to jump over to your newsletter. We're talking with Lyn Alden again today, but she does a good job, I think, and I follow her blog, and just go to lynalden.com. You can find out what she's investing in. This is her newsletter, multi-asset portfolio model that she's done. Dividend stocks at 27%, international ETFs at 18%. Then you can kind of see the commodity production, and then a lot in, 5%, I should say, a good mix in things like the Grayscale, Bitcoin Trust, MicroStrategy. I see you've got a position in there. When you look at growing any one of these positions over the year, do you feel like right now the current status that you're in with your split of what you're doing, for your newsletter, is that kind of what you've matched for the year, or are you thinking about maybe juggling some of those percentages throughout the year?
So often what I do is rebalance based on conditions. So ever since springtime of 2022, and when the economic data was clearly decelerating and the Fed was clearly intent on causing that deceleration, I basically made the point that you want to be in cash, you want to be in gold, you want to be in defensive value stocks, things like healthcare, things like energy
Right,
pipelines, things like that. That was kind of like my core position. That type of investment has outperformed, whereas, for example, more cyclical things like Bitcoin have underperformed. A lot of leverage is wiped out. I do think that going forward, some of these cyclical um, things are getting interesting. So, for example, I've been banging the table a little bit on banks. I think banks are somewhat oversold here. I
okay,
also do think that Bitcoin is kind of in a deep value zone after so much capitulation. So I'm a lot more constructive on some of these, more volatile type of investments. It doesn't necessarily mean that I think the bottom's 100% in,
right.
but I think that it's either in, or that we're at least in the later stages of these types of drawdowns for those types of assets. Whereas I'm still quite concerned about, for example, the Teslas and the Apples of the world. I do think that they could have poor, say, 5-year returns
Mhm.
compared to, say, something like bank equities or something like Bitcoin that I expect to do better. So overall, I have been emphasizing that mix. Basically, on one hand, you have the
Right.
conservative cash flow producing assets, and then I do take certain risks in emerging markets or Bitcoin that are historically more volatile, and I'm essentially staying with that position and just leading into things that I think have maybe already had a lot of their downside done. And touching on Grayscale, so that particular portfolio is at a particular brokerage account, whereas, for example, I do recommend that for people that buy Bitcoin, you should try to self custody it, right? So a
Right.
broker holding something in like a GBTC or a MicroStrategy is if you have a brokerage, sometimes those are your only options. I do
Mhm.
think we should have a spot ETF in the United States, but whenever possible, people should try to self custody and own their own Bitcoin, which of course I do as well.
Yeah, I mean, it's one of the things we preach here on the show often is self custody really is kind of the only way. If you are, self directing your investments out there. All right, so I want to thank our sponsor today, and that is Trezor. If you're looking at self custody for any of your crypto assets, this is the place to do it. One of the things I really like about Trezor is the fact that you've got a couple of options. You can go with the Trezor Model 1, one of my favorites, but the one I really like is the Trezor Model T. This, of course, is another reason for self-custody is they make it so easy for you guys to actually do this. So first thing you got to do is just visit their website, trezor.io. If you want to get into using their software, they have a whole program and software called the Trezor Suite. It really makes it very simple to use and super affordable. So make sure and check this one out. It does help the channel out. All right, so last question for you, and this is something more around. I've had a chance to talk with Corey Clifton quite a bit with Swan, and Corey and I have had, we go back and forth on all this stuff, but I'm looking at it from a sense of adoption, and I think about where the market is right now, the risk assets, especially Bitcoin, and what we may see in the growth here coming up. If we have actually reached a bottom or in a zone that at least capitulation has occurred, this is a good safety area of where potentially investments will start to occur. it's also an area where you're going to start to see new people coming into the market. And one of the things, this is something, I coach on high net worth individuals on the weekends, and we talk about Bitcoin and risk assets and things like this all the time. The biggest thing that they bring up to me, and I just want to get your opinion on this, is what seems to be, I won't say just a Bitcoin maximalist approach toward when you get into Bitcoin or you're doing something over here with an altcoin or something of that nature. It's the community approach. Do you feel like the scenario that's being painted out in the market right now from and around Bitcoin is more inclusive or less inclusive? Because I'm getting, kind of measurements from some people that they feel it's less inclusive. What are your thoughts on how we might see adoption occur in the next run?
So I think it depends on what part of the ecosystem you look at, right? So a lot of people focus on, for example, Bitcoin Twitter, which they
Right.
might mistakenly assume that's all of Bitcoin, whereas of course
Hmm.
that's the more vocal public group. Whereas if you look at the developers, a lot of they don't have time for Twitter. They're only
Right.
marginally on Twitter in many cases, and a lot of times they have very different views from the rest of the space. So I think there are pockets of Bitcoin where if you're an intellectually honest person, I mean, you can fit in many different places. I think it's a very
Hmm.
inclusive space in that sense. I think the way I would phrase the parts that seem rough around the edges is that on average the community is like very open and aggressive about calling out things that they perceive as scams. And I think that
Yeah.
unfortunately this ecosystem has been kind of ripe for scams because the way I phrased it before is that by allowing peer-to-peer money, the same technology that allows for peer-to-peer money also accelerates peer-to-peer scams, right? So
Sure.
for example, before if you wanted to scam people, it was like direct mail, things like that. If you wanted to go through investment opportunities, generally that the SEC would be some degree of a barrier. If you want to get someone in penny stocks or things like that, you're still going through the SEC in some way. Whereas this technology is allowed for security basically to be sold to the public in a way that goes around a lot of those other uh, historic safeguards. And I think there's a lot of active debate. I mean, whether those safeguards were ever really effective.
Hmm.
But because this technology kind of, at least temporarily, in this kind of arbitrage, like regulatory gray zone at the moment, because they kind of go around those, it's sort of a haven for scammers. Even though, of
Yeah.
course, there are plenty of people that are doing plenty of interesting things in encryption. There are a lot of serious people in the space, but because it's such a haven, there's so much affinity scamming. There's so much pump and dump schemes and things like that. And so I actually think you, I do think it's good to pay attention to a lot of the people that might seem closed-minded, because a lot of those have been through multiple cycles and have seen a lot of these
Sure.
before. So
Yeah.
I do think you have to balance a little bit, but I do think that it's a reasonable heuristic to have a very, very high bar in this space before you'd consider something investable. And I
Totally.
think it's yeah, you want to be open-minded, but you also want to be very, very on the lookout for scams and kind of start with the assumption that most of the thousands of things out there, unfortunately, are scams.
Yeah, this is the thing. It's interesting you said that. That's the first thing I do when I present is first thing you're going to know about risk assets, everything's a scam. Now let's go to talking about things that might be a potential opportunity. So definitely a good one. Lyn, it's been great having you on today. Thank you so much for stopping in. We appreciate it.
Thanks for having me.
You bet. All right, so you guys are tuned in maybe on the podcast side of this audio, but you can also catch this on our full YouTube channel, which is typically where most everybody comes. You get a chance to see charts, a lot more analysis breakdowns. We do a ton of analysis on projects, but also kind of the direction of where markets are going in general. It's very easy to jump into our Diamond Circle, which is our own private email group. And we drop in most of our content so you can keep up to speed on that, all that good stuff. Of course, if you guys want to reach me, it is out there on Twitter at Paul Barron. We'll catch you next time right here on TechPath.